So last week we started discussing about depreciation. Okay. So what is depreciation? What we studied last week? Just we'll recap what we have studied last week. Okay. So what is depreciation?
It reduces the value of the asset.
Okay. So depreciation means falling value of an asset. What does it mean? Falling value of an asset. Okay. If the value falls, that is known as depreciation. Okay. So something like, let's say, the condition of the asset, it reduces due to usage and sometimes it might damage. Okay. So due to those conditions, so those factors, the value of the asset will reduce, it will fall. For example, let's say now you purchased an asset in 2015 for $100,000. Okay, and this asset you can use it for 5 years. Okay, so in 2020, if you want to sell this asset, can you sell it? Can you fetch the same amount that you paid for this asset?
No.
Can you fetch? Can you sell it for 100,000? No.
No.
Because this is, the condition has changed over a period of 5 years. Okay. So when you use an asset for a longer period of time, it will change. Okay. So therefore you cannot sell it at the same price. So probably you can buy a brand new asset for this particular amount. Okay. So therefore over a period of usage, the asset value will come down, will reduce. So that is known as depreciation. And also we went on to discuss what are the causes or the reasons of depreciation. Okay. So what are the causes or reasons for depreciation?
Physical depreciation,
Hmm.
economic factors.
Yeah. So we discuss these under different headings, no?
Yeah.
So the first heading, this is according to your textbook. Okay. So first one is physical depreciation. Second one,
Economic factors.
economic factors. What else?
Time factor.
Yeah. Time factor.
And
Finally,
then depletion.
depletion. So these are the causes or the reasons for depreciation. So physical depreciation, under that, under which we have discussed 2 points. So first one is the wear and tear of the asset. So basically this is due to usage. So due to usage, the asset will damage. So as a result of that, the value will reduce. So this is known as wear and tear. And what is the other factor?
Erosion, rust.
Yeah. So yeah, due to erosion, rust, decay, no?
Yeah.
For example, let's say your business is near to the sea. What will happen? Due to sea air, what will happen to the assets?
It will get rust.
Yeah, if your assets are made out of, let's say, iron or metals, it will depreciate, it will eat up the asset. So as a result of that, the value will come, like air conditioners, okay, like furnitures, fans, those kind of items. It will easily get corroded. So as a result of that, the value will come down. Economic factors. What are the economic factors we discuss?
Obsolescence.
Obsolescence. Some people they say obsolescence.
Obsolescence.
Okay, but I just checked the what do you call this, dictionary. Okay, so the correct pronunciation is obsolescence. Okay, due to when you use the asset over a period of time, due to obsolescence, yeah, it will become outdated. Okay, so first one is obsolescence. Okay, and the second one is,
Trade away.
what do you mean by trade away? No, inadequacy.
Oh, sorry. Inadequacy. I'm sorry.
Okay. So what does this mean, obsolescence?
It means out of date.
Yeah. So your asset will become out of date, outdated. For example, I discuss some examples. Due to fast-paced technology, change in technology, okay, so you will not be able to use computers. Okay, so every 3 years you will have to change the computers because you will get new features like mobile phones. Okay, so easily those kind of assets will become outdated. What about inadequacy? What does it mean?
The change.
Yeah, change in the business. If there is a growth in the business, you will have to expand the business operations. Okay, so probably let's say now you have a factory, manufacturing plant, where you can produce 10,000 units per annum. Okay, but there is a growth in the business, expansion in the business. So probably, okay, the company will have to cater for a larger market, 30,000 tonnage, 30,000 units of item will have to be produced. So they will have to move from smaller manufacturing plant to larger manufacturing plant because due to inadequate facility. So this is inadequacy. Okay, those are the economic factors. Then the time factor. Okay, so time factor we discuss. Let's say if the asset is used for a limited number of years, okay, then within that number of years you need to depreciate the asset. For example, let's say the acquiring company and a leasing company will have an agreement. Okay, so based on the agreement, let's say the agreement says 10 years. Okay, so you can use the asset over a period of 10 years. Okay, for example, leasing, lease agreement. You understand? Then depletion. What does it mean?
That means you can't have that product for a long period of time. That means
for example,
like mining.
Yeah.
Or then
oil fields.
Yeah.
So those oil fields and mining, okay, mines, okay, so you can use it for a certain period of time. For example, 25 years, 50 years. So those companies who are in that industry will treat those assets under their balance sheet, and they will depreciate over a period of certain number of period. Okay, so after which they won't be able to extract these oils. Okay, so they will have to depreciate. So this is known as depletion. Okay, so these are the basically these are the factors that we discuss under causes for depreciation. Okay, then afterwards what did we discuss?
How to calculate depreciation.
Yeah, calculation of depreciation. How to calculate depreciation. Okay, so methods of calculating depreciation. Two methods we discuss. What are those two methods?
Straight line method and reducing balance method.
Yeah, so basically we discuss two methods: straight line method and reducing balance method. Okay, so these are the two methods that we discuss. So under straight line method, how do you calculate depreciation?
The formula?
Yeah, there is a formula. So what is the formula?
Cost
Yeah, cost price
minus disposable.
minus disposal value,
The disposal value.
disposal value over
Usefulness.
useful life,
Useful.
useful life of the asset. So this will be the depreciation. Okay. For example, let's say cost price is $120,000. Okay, and your depreciation value is, sorry, not depreciation, disposal value, or in we have other terms also, resale value, scrap value. Okay, so disposal value means the value that you can fetch after the usage of the asset, after a certain period of using the asset. Okay, so disposal value is, let's say, 20,000, and this asset can be used for 5 years. Then how much will be the depreciation? So 120,000 minus 20,000, so which will be 100,000 divided by 5. How much is that? 20,000 per annum. Okay, so under straight line method, you need to charge your depreciation every year over a period of 5 years. Okay, 20,000 each. Okay, so it's equal amount will be charged every year. You understand? Is that clear?
Yes.
Okay, so when you take this, let's say 120,000 is your cost, 120,000. You understand? So first year how much you will charge as depreciation? 20,000, no? So what is the remaining balance at the end of the first year? 100,000. Then again second year depreciation is how much? 20,000. So equal amount will be charged. So this will be 80,000. Then third year also 20,000. So remaining balance is 60,000. Likewise, you will continue to charge the same amount every year. Okay, so this is known as straight line method. Okay, and also there is another method where you can calculate the depreciation under straight line method. What is that method? You can identify a certain percentage. We call it installment method. Okay, so how do you identify the percentage? How do you identify the percentage? Now useful life is 5 years. If it is 5 years, okay, rather than using this formula, straight away you can apply that percentage and you can calculate 20,000. How you will do that? How you can do that? So 5 years means, okay, if you divide this by 100, okay, how much is that? 20%.
20.
Okay, so if you apply 20% on 100,000, no, this is 100,000. On that 20% is how much? 20,000.
Yeah, 20,000.
Same amount but different calculation. Okay, so either you can use the depreciation formula method. Okay, so where you take 120,000 minus the disposal value divided by 5 years, economic useful life of the asset. Otherwise, what you can do is you calculate the percentage to be charged every year. So how you will calculate? Since it is a percentage, what you can do is you take 100% divided by the useful life of the asset. Supposing let's say the useful life of the asset is 4 years. How much you will charge? What is the percentage to be charged? 100% divided by 4. How much? 25%. So this is how you calculate the percentage to be charged under straight line method. So straight line method, basically what we do is we just charge an equal amount as depreciation every year. So every year we charge equal amount, 20,000, 20,000, 20,000. Fourth year, fifth year also we charge equal amount. Okay, this is straight line method. However, under reducing balance method, how do you charge depreciation?
You charge it for every price. That means if you get 100,000, you charge a depreciation, and then the next value you get, you will
the balance.
Yeah. You will use.
Reduced value.
Yeah.
On the reduced value, you charge the depreciation. For example, we'll assume, let's say the asset value, let's say 50,000, and you depreciate at 20%. Okay, so how much is the asset value? 150,000.
Yeah.
Then how much is the depreciation?
20.
First year?
20%.
Yeah, 20% on this. How much is that?
20% on that is 10,000.
10,000. Okay. So you minus 10,000. Then the remaining balance is 40,000. Second year depreciation. How much?
8,000.
8,000. So remaining balance is 32,000. Okay.
Yeah.
Third year, how much?
1,600. Oh, sorry. 6,400.
6,400. Okay. So likewise, so now the remaining balance will be 25,600. So you will continue to charge on the reduced balance. Okay, not on the original cost. Okay, so this is charged on this original amount, but 8,000 is charged on the reduced balance. This is also charged on the reduced balance. So whereas fourth year also you will charge 20% on the reduced amount. Okay, so this is known as reducing balance method. Is that clear? Okay, so you should be able to identify depreciation. You should be able to calculate depreciation based on straight line method as well as reducing balance method. Okay, now the next chapter is topic is recording depreciation. Okay, accounting for depreciation. For that, what I will do is I will give you an example. Based on the example, we will discuss the question. Okay, so can you take down this question? The machinery cost is 16,000. The disposal value is 1,000. The useful life is 4 years. Okay. Here it says the company uses the straight line method. Straight line method. Okay, first and foremost, calculate the depreciation. Calculate the depreciation. You understand, under straight line method. Please calculate and let me know the depreciation, that amount that to be charged. Okay, so let's calculate the depreciation. How much is the depreciation you calculated now?
3,750.
So how did you calculate? So depreciation under straight line method, the cost is how much? 16,000 minus the disposal value over 4 years. Okay, so 16,000 minus 1,000, 15,000, so which will be 3,750. Okay, so this is dollars. So every year you should charge 3,750. You understand?
Yes.
Otherwise, you can calculate the depreciation based on a percentage. How do you calculate? This 15,000 you can multiply by the percentage. Okay, since it is 4 years, I told you if it is 100%, which will be 25%. Okay, so you can apply 25% on 15,000. So how much is that? 3,750. Okay, so this way also you can calculate. Okay, so you can reduce your time by applying this method. Okay, now let's look at how to record this depreciation. Okay, so depreciation is treated as an expense. Okay, so when you pay an expense, how you will record? What is the double entry? Let's say you are paying salaries. You paid salaries $5,000. So what is the double entry?
Credit cash
Mm-hmm.
and then debit salaries account.
Salaries account. Okay, and we treat this as an expense. Okay, so where do you debit depreciation? Then, since it is an expense, you debit the depreciation account. Where you will credit? Where you will credit? Is there a cash outflow?
No.
No. Okay, there is no cash outflow. Please understand this. Okay, otherwise, if you accrue certain expenses, what you will do? If you accrue salaries, salaries account debit, and you credit the liability account, salaries payable account. If you don't pay salaries, okay, subsequently it will be paid. Okay, so if you are accruing an expense, what you will do? That particular account, salaries account debit and salaries payable account will be credited. If it is paid, then salaries account debit and either bank or cash account will be credited. That's the double entry. But in this case, depreciation, there is no cash outflow. Okay, so therefore what you have to do is you need to debit the depreciation account 3,750. Okay, so this is the first year, put the date, and you need to credit somewhere. You need to credit somewhere, otherwise your balance sheet will not balance, the financial position or the trial balance will not balance. Okay, so dual impact under double entry accounting. You understand? So you need to credit this account. What is this account? This account is known as provision for depreciation account. We had to create a provision account. That provision account is provision for depreciation account. Why? When you debit one account, you need to credit another account. So therefore, this is provision for depreciation, and this is the first year. This is the depreciation expense account, 3,750. This is kind of a reserve account, fund account. Okay, so at the end of the fourth year, you should have the required amount to purchase or replace your old asset. It's kind of, you are just reserving that money. Okay, so that's why you are creating a provision account. You are setting aside every year certain amount to this provision account. Okay, so eventually this provision account we should equal to the cost of the asset. You understand? It's something like a reserve or fund account. Okay, so in fact it's not really a fund account. For the bookkeeping purpose, what we do is we just create a provision account. Is that clear? Okay, so what is the double entry? Depreciation account debit, depreciation expense account debit, and provision for depreciation account credit. You understand? Okay, take down this.